The Fed cut interest rates. Looks like real estate is back on the menu. Or is it? Hey everyone, welcome back to the channel. I'm Fahad Siddiqui, and today we're talking about something that impacts almost every homeowner, buyer, and investor out there: interest rates. Interest rates inherently affect mortgage rates. Now, whether you're a first-time homebuyer or seasoned investor, understanding the relationship between interest rates and mortgage rates can help you make smarter financial decisions. First things first, what exactly are interest rates? In simple terms, an interest rate is the cost of borrowing money. It is set by the central bank. Here in the US, that's the Federal Reserve, the Fed for short. The Fed uses interest rates to control inflation, keep unemployment low, and help ensure the economy stays stable. When the Fed raises or lowers interest rates, it sends ripple effects throughout the economy. And one of the areas it impacts us directly is mortgage rates. Now, let's talk about the connection between interest rates and mortgage rates. Think of interest rates as the main driver for how affordable or expensive mortgages become. When the Fed raises interest rates, borrowing money becomes more expensive, and mortgage rates tend to go up. This makes monthly payments higher, and as an end result, homes become less affordable for buyers. Now, on the other hand, when Fed lowers interest rates, borrowing money becomes cheaper, and mortgage rates typically go down. This can boost demand for homes since buyers now can afford more larger homes, and they're gonna have lower monthly payments. Now, it's not just the Fed that influences mortgage rates. Another big player in the game is the 10-year Treasury bond yield. Lenders like banks often look at this as a benchmark because it tends to move in tandem with economic trends. If the yield on the 10-year bond goes up, mortgage rates usually follow up as well. Why is that? Because lenders want to match what they could earn if they just invested in government bonds instead of giving out mortgages to lenders and buyers like yourself. Let's picture mortgage lenders as investors. Like any investor, lenders are in the business of making a profit, and equally important, protecting that profit. When a lender decides to offer a mortgage rate, they're not just setting a number out of nowhere. They're weighing risks and returns to make sure the investment makes sense for them. For lenders, every mortgage is an investment. They're giving out large sums of money with the expectation of earning it back with interest. But here's the thing, they need to consider what risks are involved in the process. Now, one of the main risks lenders evaluate is the borrower's creditworthiness. In other words, they're assessing how likely it is that someone will pay back the loan. They do this by looking at a borrower's credit score, income, debt-to-income ratio, and overall financial health. If a borrower has a high credit score and a stable income, lenders see them as lower risk. But if a borrower has a lower credit score or an inconsistent income, the lender might view them as a higher risk, and a higher risk usually means a higher mortgage rate to help offset that. Now, here's an interesting comparison. Lenders, when setting mortgage rates, aren't just looking at the risk of lending to individuals. They're also considering the economic health of the US government. They compare the creditworthiness of the average borrower with that of the US government. The US government issues Treasury bonds, which are considered one of the safest investments in the world. So lenders look at how much they can earn by investing in these government bonds, which have virtually no risk of default, versus lending to the public, which comes with a higher risk. Mortgage rates are often more in line with Treasury yields because lenders want to make sure that they're earning enough to justify the added risk of lending to everyday borrowers like you and me. Since Treasury bonds are such a secure investment, their yields, especially the 10-year Treasury yield, serve as a benchmark for mortgage rates. If the US government is offering a certain return with minimal risk, lenders know that they need to offer a higher return on mortgages to make it worthwhile. The difference accounts for the risk of default with regular borrowers. When Treasury yields rise, mortgage rates tend to rise too. When Treasury yields fall, mortgage rates tend to fall as well. It's a way for lenders to balance their investment options with the relative risks involved. Now, what does this mean for buyers and sellers? When interest rates are low, buying power increases because lower mortgage rates make it easier to afford higher priced homes. So you'll often see more people jumping into the market when rates are low. Sellers also benefit because they may get multiple offers, possibly even rising above the asking price. But when rates go up, it can cause a slowdown. Buyers may find themselves priced out of the market or may need to lower their budget. Sellers may see fewer offers and might have to lower their asking price to attract buyers. So, what can you do in today's interest rate environment? Here's a few tips. Get pre-approved. Knowing your borrowing power can give you a clear picture of what you can afford. Consider locking in rates early. If you're planning to buy soon, consider locking in a rate with your lender before they rise. Shop around. Mortgage rates can vary between lenders, so it pays to compare and keep them competitive. Think long term. Don't focus solely on the rate today. Consider the big picture. Are you planning to stay in the property long term or flip it? Understanding how interest rates affect mortgage rates can really help you make informed decisions, whether you're buying your first home, investing, or considering refinancing. Interest rates play a major role in affordability and the housing market overall, so keeping an eye on them can give you a financial edge. Thanks for watching. If you found this video helpful, please give it a thumbs up, subscribe for more insight, and leave a comment if you have any questions or comments. Also, I want to remind you guys that we are hosting a live webinar next week, Tuesday, November 19th. I invite you guys to come learn about all the things that we're doing here at King's Private Equity Group. We're going to talk about maximizing ROI, new construction development, and the overall market cycle. So I look forward to seeing you there. Hit the link below to register. And until next time, keep building toward your financial goals.